Welcome and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Fort Worth, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. However, if you are not attending for CPE, feel free to enjoy a brief 30-second break during each polling question. Additionally, please use both the chat and Q&A functionality, which is located in the upper right-hand corner of your screen. If you have a question specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. We're happy to stay on past the scheduled time to ensure that all of your questions are answered. And lastly, a PDF of today's presentation is available for download now, should you wish to follow along or reference it afterwards. With that, let's get started. I'm pleased to introduce our presenters today. The first is Matt McKinney, who is our Senior Director of Tax Accounting Methods and Credits. Matt has over 22 years of combined public accounting experience in the areas of tax compliance accounting for income taxes, capital cost recovery analysis, and accounting periods and methods. While Matt has served many different clients for tax compliance and consulting, he has specific industry specializations working with public utilities, telecommunications, aerospace and defense, and manufacturing companies. Additionally, today we have Imran Syed, who joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years of experience in sustainability and energy efficient buildings. He is a registered professional engineer, a certified energy member, a lead AP, a HERS rater, an NGBS verifier, and Energy Star partner. And with that, I will hand it over to Matt.
Hello and welcome. I'm going to take us through our quick agenda today. We're going to be talking about OBBBA or OB3. It has numerous names, so I'm just going to refer to it as our new tax legislation. We're going to talk about depreciation first, namely bonus depreciation and the changes there. And then I'll move us in to talk about research and development expenses and what has happened with 174 and talk through some of the nuances. And then I will turn it over to Imran to talk through selected energy items, 179D, 45L, and then ITC and PCC. I'm going to move through my slides fairly quickly. As Ann mentioned, our goal here is to present the topics that we're talking about, but then turn it over to you and make sure that we cover as many of your questions as possible. Moving us into depreciation. Here, and my plan is not to tell you the same rules that you've heard over and over or that has been broadcast by the tax media everywhere, but dive into a little bit of the nuances for these. First of all, as everyone has probably heard by now, 100% bonus depreciation has been reinstated for property acquired after 1/19/2025. And then we have a new addition, which we are getting closer to everything at this point being bonus eligible. But now we have qualified production property, or QPP as we'll call it, that if you have something that begins construction after January 19th of this year and before January 1 of 2029, and then is placed in service by 2031, this property has to meet certain definitions. And we're going to go through some nuances there and why we need regulatory guidance. So before we kind of start into some of the details, I'm going to move us to our first polling question.
All right. Do you anticipate your business or clients to increase capital spend due to the renewal of 100% bonus depreciation? A is yes, B is no, and C is not applicable. Again, you do need to respond to 3 of 4 polling questions and to remain on the presentation for 50 minutes in order to be eligible for CPE. And it looks like most people are answering A, yes. What say you, Matt?
Well, we'll start moving ahead. So the first item is, okay, bonus depreciation is back. What does that mean? And what are some of the nuances? Typically, we've been in bonus periods for most of the last 2.5 decades. But when we're entering and exiting bonus regimes, it does matter not only on when the property is placed in service, but when and how the property was acquired. So we're going to really focus on that so that all the practitioners and taxpayers out there think about that, because 2025 is going to be a little bit more difficult as we get a little closer or further in. It gets easier because you don't have to worry so much about property that may be acquired before. So we're going to talk about acquired property, and this, I mean property that is ordered and not constructed or think custom manufactured, but off the lot property that is under contract. So when you have a written binding contract, this will set your acquisition. This will set the acquisition of property. So if it's actually contracted prior to January 19th, you've actually acquired it before. Remember, you have to acquire it and place it in service after. So a couple of things to think about with written binding contracts. So they have to be legal under state law. So that is a little bit more of a legal question, but the IRS does give us binding information on what is binding as it relates to these contracts that are enforceable. So the biggest thing and the most important thing to know is that if you have contracts that limit damages, and to think if the fact that if you have a limitation waiver, or the easy example is if you contract to purchase something, but then you can get all of your money back, that's not going to be binding. So there has to be essentially a penalty of at least 5% of the contract price that the purchaser is going to give up to be binding. If you think the IRS's point here is to not have taxpayers enter into contracts that they can easily walk away from and game the system. Well, on the front end, that doesn't make a lot of sense. But there have been times that we have been exiting 100% bonus regimes where this does become important, especially for long live production property. So a couple other things to think about here is you do have the legal considerations. Is it legally enforceable? Is it subject to conditions? So essentially, if they're not within the control, if they're regulatory, that will not change the fact that it is binding. Also, if they make amendments, that's, if they're not, substantial, those are not going to change the fact that a contract is binding. One of the things to really take away from this is if you have large, pieces of equipment or properties being purchased, you need to check the contract terms. The other side of this coin is property that you construct, or property that's constructed for a taxpayer or manufactured for a taxpayer. Think custom manufacturing in those regards. So self-constructed property is acquired when work of a substantial nature begins, and this matters whether or not you have a contract or not. So the rules apply the same. To simply put this is physical work of a significant nature, most taxpayers use to safe harbor. The safe harbor here is more than 10% of the hard costs. So your land, your design fees, things of that nature do not count. It's going to be the actual construction costs that matter. So, those are things to pay attention to. And, obviously you'll have to compare to the actuals at the end, but you can get an idea, as far as the budget layouts that you expect versus what has been spent thus far. But when you have self-constructed property, whether or not it's under contract, it is important to figure out how much has been spent and what it's been spent on, especially if they're close to that 10% number. A couple of very important items to think about with self-constructed property. Your overall accounting method matters. For cash basis taxpayers, it is when paid. For accrual basis taxpayers, it's when it has been incurred, otherwise known as when property or services are provided. You won't see this in real estate construction contracts, but you may have in custom manufacturing, think turbines, things of that nature. You could have turnkey contracts for accrual basis taxpayers. In this instance, if you do have turnkey contracts, and these are technical in nature, but all the costs are acquired at the end. So even though there's a contract at play, it may not mean that you've acquired that property prior to entering the 100% bonus period. Moving on to our new item, qualified production property. I'm going to focus here less on the dates, but maybe on some of the things that haven't been talked about. Some of the things that we're going to need regulatory guidance to help us with here. Clearly, this applies to non-residential, and I've highlighted that word, in the portion of new construction that's going to be used in a qualifying activity. So the construction has to begin after January 19th of 2025 and before January 1st of 2029. And then it's got to be placed in service before 2031, although there is a regulatory guidance that could give us a little bit of an extension there. So those dates also are included for property that not only is constructed, but it does allow for property that has not been used by any taxpayer for the date range that you see on your screen, or by the taxpayer themselves that has never been used in a qualified production activity. So essentially you can buy a property, let's say it was a rental real estate or an apartment building that has now been converted into manufacturing. You can acquire property and then turn it into manufacturing, and it will meet that definition. However, the acquisition dates are the same, which is a little bit of a nuance that I'm not sure that from reading the congressional notes if they had planned on, but in the statute, that is what has set in. One of the things that is important here is the definitions. First and foremost, substantial transformation. That has to be defined by future regulatory guidance, but they do point to the subpart F regs that do define this. So we also included in our handouts an article that we put together, and I did describe in that some of the examples. I'm hoping that our regulatory guidance gives us a little bit more flavor as to what this means, because the examples there are pretty cut and dry, or pretty plain to see. But from those regs, you can see that mere repackaging or rebranding is not going to qualify. You actually have to be producing something. And speaking of production, only agriculture and chemical production will apply. So if you think about oil production, or I had someone ask recently about a water treatment facility, those are going to get excluded. But as you can imagine, that when they use the term any tangible property other than you in the statute where food is produced in the same retail facility that's sold. You can imagine that there are going to be some gray areas that get closer to that line than some of the more obvious examples of manufacturing, production, or refining. Now, in those cases, I think it's important to talk to your clients and your management about, hey, there are certain instances where the guidance may not be clear, but there can be a case to be made that you are a qualifying activity. So backing up a little bit to the first bullet here, I want to make sure everyone understands that when they say non-residential real property, they mean a portion. So they're going to exclude spaces used for office, et cetera. But there's a catch-all. Essentially, anything that's not related to the manufacturing or production activity is going to get excluded. But it's important to note that you do have opportunities here when you think about that space and you're building a property. Yes, you're going to have to analyze all the space to make sure it is of a qualifying activity. And you're going to have to exclude sales, research, parking, other facilities. But it's important to know, and maybe cost segregation is the answer here, because you're going to want to make sure that you're picking up all of those utilities, power, water, HVAC, that also not just the structural components that are going in to that manufacturing space. And it's more than just, a square footage test. You may want to think about, well, the manufacturing space is probably going to use more power. Granted, the machinery equipment, you're gonna make sure that you cost segment and reclassify to that, but still that space is going to be bigger. It's going to need more HVAC for the personnel. It's going to need more lighting. It's going to need more power to push those items. So I think there are things that taxpayers can think about to maximize their value. But of course, we're going to be waiting on further regulatory guidance to help us along. But the statute has given us some cues and to where to look to at least begin our planning. One important note, or a couple of important notes I want to talk about, with property that is acquired, meaning this is a space that has never been used in a qualified production activity. So unlike other property that is self-constructed or where you're going to produce a property or a bonus depreciation, your written binding contract here is going to matter. It's going to set the dates for when you've acquired it, both on the front end and the back end, when you're thinking about that 1/19 date or that 1/1/29. So that's very important to pay attention to contracts and when that contract was entered into. A couple of other things or at least one big other item I want to touch on is the taxpayer in the plain reading of the statute has to utilize the space. It's very clear that lessors do not qualify. Now, I'm hoping that we get regulatory guidance, and this may be a place where comment letters are warranted for you CPAs out there. Discussing this with the AICPA and getting them behind it potentially. When they write this type of legislation, they're clearly thinking about the big manufacturers, automakers, auto part makers, public companies, C corps. But as we all know from the first day of tax school, we're told to not put real estate inside of a corporation. Well, so for many of our smaller taxpayers, they want the operating entity in an S corp, but that property is going to sit in an LLC. And I think that there has to be some thought given to this by those writing the regulations, or at least that is my hope, because in the pure spirit of this law, that's not what it would be meant for, us to shut out small taxpayers. But until we get guidance saying otherwise, that is an important point that you need to discuss with your clients if they're embarking or planning on embarking in constructing spaces that may qualify for this provision. And as I'm moving quickly through this to make sure that we have time for questions, as you know, the new bill has put us back to expensing 174 costs, or your research and development expenses. So you back with TCJA, no one ever thought that we were going to see the day that after 2021 we had to capitalize these costs. Regulations were never written, but of course it happened. Well, they finally found a way to do what they've been trying to since 2022, is reverse this. So as many of you know from the passages bill, for tax years after December 31st, 2024. So remember, tax years, not cost incurred. You get to revert back to expensing 174 cost. However, if you're a small taxpayer, $31 million gross average receipts, you can elect to apply this to after 2021. And then all taxpayers get an option to expense their remaining amortization either over 1 to 2 years. So small or large taxpayers can take advantage of accelerating them on unamortized costs. But it's important to note. So I think everyone knows what to do here. This isn't new. Expensing 174 cost isn't new. However, there's some nuances and guidance that is needed. Notice I highlight domestic. This is for domestic expenditures only, and nothing has changed related to foreign. You're still going to capitalize those over 15 years. You do have options. We are going back to circa 2021, where you have the option to capitalize over 5 or 10 years, 174 expenditures. So why do we need guidance? For most taxpayers that may have capitalized in the earliest year, they filed their method, they filed their statement method change, they started capitalizing and amortizing. Most of them are probably going to be in a straightforward boat of where they know where they need to be. However, they still need procedural guidance, because unfortunately this is treated as both elections and method changes. They're using two terms that usually don't go together, but they are putting them together. Well, typically for accounting method changes, for automatic changes, you can't file the same change within 5 years, so you need a waiver. So for any taxpayer, we're still going to be within, most taxpayers are going to still be within 5 years. So everyone is going to need that waiver and that statement change, which is my expectation. We won't file 3115s, but we're going to file statements. Taxpayers are also going to need guidance on how to elect to go back to their first impacted year after 2021. The statute is clear that if you're a small taxpayer, you have the option to elect, going back. But not all taxpayers will. Some taxpayers may be in the position where they need to model this out. What if, what if you have income and back years are not in forward? You certainly may want to, if you're a small taxpayer, to go back and amend. But from a cash flow standpoint, if you're in a net income position, either in the front or the back end of those, from a cash flow position, you may not want to amend, because as everyone has probably realized, the IRS has been a little sluggish over the last couple of years in processing amended returns. So you may be better off from a cash flow perspective waiting. Large taxpayers or even small taxpayers may not want to elect to accelerate those unamortized costs, because it may create NOL. So while this is enacted, there are taxpayers that are going to want to move quickly, and they may want to move for 2024. The correct answer is probably wait for guidance if you can, but we also know that in some cases you may have statutes expiring, short years, things of that nature where you can't. Well, the statute is clear on a lot of things, and but if you can, waiting for that guidance is important. So I look forward to the questions, and I'm going to move us to our last polling question, or our second polling question, but the last for my part.
Thank you, Matt. And the question is, will you be amending tax returns to retroactively apply the new Section 174 expensing rule? A is yes, B is no, and C is NA. While we're waiting for you to weigh in, we do also have a document in our handouts for the QPP. If you have more interest in learning more about that, that is included in our handouts tab along with this presentation. All right, again, you need to respond to 3 of 4 polling questions, and it looks like most of you think, well, it's fairly close between A and B, but B is winning out. So with that, I will hand it over to Imran.
Thank you, and thank you all for joining again. So switching gears here, let's look at the impact that the Big Beautiful Bill had on the energy tax incentives. Now, there's obviously a lot of incentives that are impacted, but for this presentation, we'll focus on 3 categories. One is Section 179D, and then Section 45L, and then the investment and the production tax credits. Section 179D dealt with commercial and residential, high-rise residential buildings, and based on the energy efficiency of the building, there was a tax deduction up to $5 per square foot. What the Big Beautiful Bill does is sunset 179D for projects that start construction after the 30th of June 2026. So projects that start construction prior to that date are still eligible for the 179D tax deduction. Now, this is certainly unexpected. 179D was permanently extended back in 2021. So we didn't think 179D would be part of this bill, but in any case, here we are. As part of the construction start date, and this, hopefully there's going to be some more guidance that comes out, but I do believe there would be 2 methods of figuring out the beginning of construction. One would be the physical work test. If projects already started construction, you've got pay apps to prove that. That would be sufficient to use 179D under the old rules. There could be the 5% safe harbor rule that may also apply, wherein if 5% of the construction costs were incurred prior to the 1st of July 2026, that project would still be eligible. Now, as far as the qualifying criteria, with regards to getting that $5 per square foot tax deduction and prevailing wage and apprenticeship, which was all part of the Inflation Reduction Act, those still remain in place. The methods and the qualifying criteria wouldn't be changing. My personal thoughts on this is the fact that it's the construction start date as the cutoff criteria. That should help projects, one, expedite construction, at least start construction. And most of these projects that start construction in 2026 are probably going to get placed in service later on in 2027 or in some cases 2028. So I do anticipate a lot of the 179D studies to go through for the next couple of years. Moving on to Section 45L, which is the residential tax credit that applies for initially low-rise, but with the Inflation Reduction Act, it was expanded to include mid and high-rise residential properties as well. When the Inflation Reduction Act came up, there were requirements about Energy Star and Zero Energy Ready certification in order to be eligible for up to $5,000 per unit tax credit. The Big Beautiful Bill starts that sunset period for all dwelling units acquired after the 30th of June 2026. There's a slight difference in how we see 179D and 45L with regards to that cutoff date. With 179D, it's construction start date. But for 45L, it's the date on which the units were leased or sold. So you want to make sure if there are residential clients who are under construction, one, the project obviously has to be certified under Energy Star or the Zero Energy program. And secondly, units are at least leased before the middle of next year. And this, is critical, especially since a lot of clients were probably already planning for 45L before the new bill came in. So with the investment and production tax rates, and there's been quite a few questions with regards to how this impacts solar and wind and geothermal. I will say this based on the Big Beautiful Bill. Solar and wind do get impacted a lot more compared to other technologies. There are a few things that are impacting these projects. One, there is an accelerated phase out for both solar and wind projects, which basically means there is an earlier cutoff compared to other technologies. Secondly, the Big Beautiful Bill brings in certain restrictions with regards to material assistance with foreign prohibited entities. Solar, as we all know, is heavily reliant on certain global camps, and therefore a lot of the products that come out of China may be terminated or would not be eligible for the Section 48 tax credit. And we'll go through those details in the next couple of slides. Fuel cell systems, however, this is a good add-on where they are eligible for the 30% investment tax credit without having to meet the zero greenhouse gas emission requirements, and prevailing wage and apprenticeship would not be needed either. So at a minimum, they are eligible for 30%. There wouldn't be any bonus tax adders for domestic content or energy community. So clearly there's some good tax incentives for fuel cells. Energy storage technologies retain their eligibility through 2033. There's going to be a phase out starting from 2034 going into 2035, but that again gives a little bit of a runway to qualify energy storage projects. Now these could be standalone energy technologies, or these could be energy storages that were connected to solar and wind projects. So all of these are still eligible, and that's certainly good news. As for geothermal systems, there's a little bit of clarity that comes with the Big Beautiful Bill Act. So GHPs, or geothermal systems, or heat pumps that are non-electricity generation, are allowed to qualify for the tax credit under the legacy Section 48. This is a big deal, just because the Section 48E, which focuses on electric generation systems, were not including heat pumps, which are used for heating and cooling purposes. But with this bill, there is an extension through 2035 for these systems to still qualify at a minimum for 30% tax credit, and there's always the adders as well. As for 45X, this is the Advanced Manufacturing Production Credit. A lot of this had to do with production of certain components, whether it's for solar or wind or critical minerals that are being manufactured in the US, widely popular in the last couple of years. It does not apply to wind energy anymore if these are produced and sold after 2027. So you do have that cutoff date for wind. However, for critical minerals, that credit is still applicable, and that phase out begins after 2030. So there is still some room for 45X tax credits to apply for quite a few clients. Polling question number 3.
All right, Section 179D, deduction for energy efficient commercial buildings, terminates for properties beginning construction after A, December 31st, 2025, B, June 30th, 2026, C, July 4th, 2027, or not applicable.
Yeah, this is certainly not a softball question.
Looks like the majority is answering B, June 30th of 26.
And that would be correct. As long as the construction begins before that date, 179D could still apply for commercial as well as high-rise residential properties. We'll keep that poll open for a bit until we get all the responses. Now, moving on, and as I mentioned early on, solar and wind are disproportionately impacted because of the Big Beautiful Bill, and this table hopefully explains why that is. Now, let me go through certain construction start deadlines and let you know that there's still some good news here. For projects that begins construction prior to the 4th of July 2026, right? Next year, middle of next year, that project is still eligible under Section 48E, and as long as the project gets placed in service within that 4-year period, which is the continuity safe harbor, that project is eligible for the 30%, if not for the additional bonus tax credits. For projects that start construction after the 4th of July 2026, those projects must be completed prior to the end of 2027 in order to be eligible for the tax credit. So you've got this cutoff date of the 4th of July, where anything prior to that, those projects are great, in safe hands. Anything after that, you do have to make sure that those projects are completed before the end of 2027 for the projects to be eligible for the tax credit. There was some discussion, during the draft legislation that came out both from the House and the Senate about eliminating the 5-year makers property for the energy properties under Section 48. Thankfully, that still remains in place under Section 48E or Section 45Y. Those tech-neutral credits automatically classifies all such property as 5 years makers. The bonus depreciation will apply as well, but as Matt mentioned, there are certain rules and requirements about getting that 100% bonus. There's been no impact to elective pay or transferability, where the taxpayers were able to sell these credits or non-for-profits were able to apply for an elective pay. Those are not impacted. But again, you also have to make sure that the system that's qualifying for these transferability credits are still eligible for the tax credit. So that's basically the major impact with these solar and wind technologies. As for all other technologies, non-solar, non-wind, any projects placed in service by 2033, you're pretty much safe and all of these tax credits would apply. There would be a phase out at 2034, which is 75%. For 2035, that's going to be 50%, and then it basically phases out in 2036. So there's a little bit of time to qualify for these. Now, one of the large adders, in a way, to the big beautiful bill was the foreign entity restrictions, and I'll go through that in a bit, but that might impact most of these technologies for projects where the construction starts after the current year. So anything where construction begins in 2036, even if the system is eligible for the tax credit, there are some additional rules with regards to prohibited foreign entities. Lastly, before I go into the next slide, legacy Section 48. Now, that generally ends for all projects that start construction after 2024. The only exception here being geothermal heat pumps, as I mentioned earlier, is still able to go after the tax credit under legacy Section 48. The only negative with this is there's no 5-year makers property for geothermal heat pumps that are qualified under legacy Section 48. So that's the only system that's impacted with the makers property. But again, the fact that legacy 48 applies to most heat pump projects is definitely advantageous for a lot of builders and developers. Moving on to a few additional investment and production tax credits. That first row basically deals with a lot of residential improvement projects, clean hydrogen, which unfortunately is terminated for facilities where the construction begins after 2027. So there's a few technologies and a few investment and production tax credits that have a early sunset period. Section 30C, which again was in the news for EV chargers, alternative fuel vehicle refueling property does terminate if it's placed in service after the 30th of June 2026. So you're still eligible for that for one more year before it is completely terminated. As for the cost recovery for clean energy, as I mentioned earlier, that 5 years makers period does apply for all technology neutral tax credits as long as those technologies are eligible for the credit. And that 100% bonus depreciation is restored starting from the 19th of Jan 2025. As for elective pay, and a lot of our clients have used that since the Inflation Reduction Act, whether these are tax exempt entities or local, state, municipalities, and local governments have used elective pay on their solar projects, on their geothermal projects. Widely popular, again, thanks to the previous bill. But there are going to be certain restrictions with regards to foreign entities of concern, namely China, Russia, North Korea, and Iran. So there's going to be a few calculations that have to be done to prove that these projects don't fall under the FEOC restrictions. If they do fall under that, elective pay would not be an option for projects starting from 1/1/2026. Polling question number 4.
All right, this is our last polling question. Under Section 48E, solar and wind energy projects are subject to early sunset compared to other renewable technologies. Is that A, true, or B, false? All right, it looks like the majority so far believe it's A, true.
Yep, solar and wind are impacted quite a bit. And I do want to mention one more thing before I go into the FEOC restrictions. On the 7th of July, there was an executive order that was signed, which basically directs the Treasury to provide further guidance within 45 days with regards to two aspects, again, mainly to do with solar and wind. Firstly, the direction is to make sure that the beginning of construction rules are not circumvented. So we are again waiting for the Treasury to provide us some guidance of how exactly are these solar and wind projects impacted. Secondly, there is also an order where there cannot be any preferential treatment on solar and wind projects, mainly to do with permitting as well as contracts. And therefore, there's going to be some guidance that will come in the next month and a half, which will tell us exactly what those timelines are going to be. As an industry, we do expect there are going to be some stringent rules where the Treasury would like to end solar and wind projects or their eligibility for the credit sooner rather than later. Now, moving on to, and this is going to be the last slide before we open this up for questions. There are, and this is again brand new language in the Big Beautiful Bill. There's restrictions with regards to foreign entities of concern, and there are 3 categories within this. And again, there's going to be some guidance that will come out regarding how we could calculate this. But for now, the thing to remember from this is the material assistance test, also called the material assistance cost ratio. The ruling behind this basically is everything's good until the end of 25. Starting from 2026, if a project starts construction in 2026, the material assistance cost ratio threshold is going to be 40%, meaning 40% or more of the material assistance or components that are used for, let's say, solar as an example, or geothermal or wind, more than 40% must be from non-FEOCs, basically not from China, Russia, Iran, and North Korea. And that calculation would have to be done on every single project starting from 2026. That threshold goes up to 45% if the construction begins in 2027. And again, so on and so forth, there's added requirements for that. Now, for energy storage technologies under Section 48E, which I just mentioned, was expanded and extended through 2033. The threshold percentage would be 55% if the construction begins in 26 and 60% if it begins in 2027. So the good news are these technologies are part of the Big Beautiful Bill. It's been extended, but there are certain added rules and regulations with regards to the foreign entities of concern. And these are certain calculations that we can get away from and must be done for all projects that start construction in 2027. Now, as I was going through this and as I was researching the Big Beautiful Bill, one thing that keeps coming back is our goal here is one, to educate what the regulations are, what the legislation states. But secondly, if we have clients where projects are right out there, they are on the fence of whether to start or not, these timelines that we went over, whether it's for Section 179D, whether it's for Section 45L or solar projects, pay attention to those deadlines. It may make sense for a lot of our clients to start construction or at least fall under that safe harbor rules. And there's probably going to be a sense of urgency now with this bill to get a lot of these projects started and in some cases actually placed into service. Matt, do you have any questions you want to take?
Yes, I have looking to, there we go. And I'll just trade off with you, Imran, or you can just tell me to keep going down the list. So the first question I see, and these may not be in timely order, but I think we can get through most, if not all, it really relates to QPP, is whether or not improvements to existing property would qualify. No, it's going to be construction of a new facility or the acquisition of a facility that has never been used, and in that case, your improvements would qualify to that, I believe, for that facility, but not to an existing facility. And then Imran, let me know if you want me to keep going.
Oh, so there's one question, and this, is regarding that 45-day guidance. So the question is, if I believe that they will get them out in time. Now, that's an executive order, so I do anticipate, and I quite honestly hope that they are able to provide some kind of guidance. And I say that just because we have quite a few of our clients waiting to know what exactly this guidance would look like before they start investing or start construction on these projects. So again, I do believe it's going to be coming in within 45 days, and I really hope that there's some clarifications with regards to the beginning of construction rule.
I think guidance is going to be important for this bill in general, but I think there is concern at the IRS that there's a shortage of manpower. This question, again, is regarding QPP, and I thought it would be popular. Would construction of a new manufacturing building next to an existing manufacturing building qualify? And I believe the answer would be yes.
Mm-hmm. Yeah. I've got one question here about, will there be any change to credits for EV charging stations construction? Now, do remember, EV charger, which is a Section 30C tax credit under the Inflation Reduction Act, actually focused on EV charger construction in areas that fall under census tract. These were not for EV chargers being built in urban areas. And so, yes, we do think there's going to be an impact. But again, there's still a 1-year period before which the tax rate sunsets. So I do believe a lot of EV chargers would probably be placed in service within the next year or so.
Related to 174, can you change retroactively if the business was a small taxpayer in 2023 but large in 2024? Unfortunately, no. It will be as of what they would be considered in 2025.
Yeah. Matt, you can take another one before I look for another question.
Sure. I got a couple here that I'm going to try to answer. So there's a question about whether or not you need a form to retroactively answer go retroactive for 174, or you need to amend. And then I have a question, and I'm going to try to combine these. Is your read on a small taxpayer retroactive treatment all or nothing, meaning retroactive treatment to 2022, 2024, not just 2024? And so the understanding is it isn't all or nothing, that you need to go back to the first impacted year, so 2022. There isn't a form, at least not now. There could be via procedural guidance, but the plain read of the statute says that the election is made on an amended return. And most see that as that would be elective. You would start that election in 2022 and carry it forward. And the right answer here is to wait for that additional guidance. I do know that some taxpayers won't have that opportunity for, if there are short year returns, closing windows, and the statute does give you, does plainly read that you have the option. If you're a small taxpayer meeting the preceding 3 years under $31 million, you would be a small taxpayer. You can amend. The problem is they haven't told you exactly how, and most taxpayers don't want to have to amend twice. But currently there is no form, and it does appear to be all or nothing if your earliest year was back to 2022.
Yeah. On that same note, a question about 179D with regards to design firms. Design firms, again, would be falling under the same timelines with regards to the start of construction. But do remember, with A&E and design firms, they do have to amend their returns, and they are subject to the 3-year statute of limitations. So with 179D slowly sunsetting, there's going to be a little more interest in trying to go back and retroactively qualify some of their design projects.
Okay. I have a couple here that are somewhat related, but one of them is interesting and is something that I had thought about recently. So the first question I have that I'm going to tie to this one is, do you have to file a 3115 if you're going to accelerate the remaining unamortized amount? So you're not a small taxpayer, or you're not going to amend and you want to accelerate. And then a question on, basically the character. Will the accelerated deduction for remaining unamortized 174 costs be treated as other expense? This is relevant for 163J because those, as many of you know, those rules reverted back to EBITDA. So, this is important to note. So to amortize or to accelerate the amortization of those capitalized expenses from 22, 23, 24 is not a method change. It's an election. So, and you would have a method change, but that is to adopt 174A, starting for tax years beginning 2025. But the acceleration of this prior capitalized costs that haven't been amortized is an election, and therefore should retain its character as amortization, which is significantly important for the change or the change for 163J purposes and ATI.
Yep, actually could probably take another one.
Okay. If you have an unfinished 2024 tax return and choose to expense 174 costs, does that lock you into having to amend 2022 and 2023 instead of expensing the remainder in 2025? If you were to go that route, so remember, the better option is to wait for guidance. But if you were to go that route, not thinking that you would amend, for method change purposes, no, because you wouldn't have had change your method twice. However, if you put some sort of election statement in that 2024 return, noting that you are retroactively applying that, typically elections you can't amend your way out. So I think in that case, it could lock you into having to go back to 2022. So you may want to think about how you do that, or think about that carefully as to how you apply that. And again, the safer answer, the better answer is wait for this guidance. The IRS knows that they need to produce this guidance, and notices and things of that nature can be produced more quickly. But as we ad-libbed a few minutes ago, we all know that the IRS is down a significant number of people. There are certain key leadership positions that are not filled, including the chief counsel. So I understand the concern there, but that is something that I would advise you to think through, just because there could be some hangups, and that's one I would want to think through more carefully. Imran, I'm going to take this one real quick. I'm assuming I got a question about QIP, and I'm assuming that the question is, does QIP qualifies qualified production activities or qualified production property? No, but QIP, it stays bonus eligible. So if you have qualified improvement property, you're going to get 100% bonus, not only today, but as the law is written now, forever.
We got 3 more minutes, Matt. We could probably take a few more questions.
Okay, I'm gonna move through some then. Mm-hmm. If accelerating remaining unamortized interest in 1 year, would that be 2025? Well, I think unamortized cost. I think that's for 174 purposes. Yes, that would be 2025, but you also have the option of 2026, or you can stay the normal route. This has been brought up. This is something that ASCPA talked about. This question is, amending is not that simple for partnerships, especially BBA partnerships. That may be an issue. Yes, that is an issue. And in fact, they're going to have to provide guidance there, because that's not the route to go for those. And that is something the IRS is aware of, and they're going to have to most certainly provide guidance there as to how those taxpayers handle that. For Section 174 amended returns, what is the date to qualify as a small taxpayer? That is, again, as of tax year 2025, would you qualify under the small taxpayer exception? So the rules are, it's under 448C for basically what allows you to be cash, the overall cash basis method. If we want to apply these provisions to our 2022 filing, the 2024 filings, will guidance be available by then? If not, we'll be forced to apply the provisions to 2025. So I'm hoping there's guidance, but I'm not confident. I don't think you're forced to apply the provisions for 2025. I think what a lot of taxpayers will do is file 2024 as if nothing had changed. And a lot of taxpayers have filed 2024, so there are in that amending return situation if they are going to apply that small taxpayer election. So if you're in a situation where you can file, wait for the guidance, and then go back and amend, that is probably the safer answer from a procedural standpoint. Going through some of these Imran answers.
And as we go through these, since we're at the top of the hour, if there are questions, I know there are quite a bit that are unanswered, we will reach out to you and respond back in a timely fashion.
All right. Well, thank you so much for joining us. As Imran said, if we have any questions we've left unanswered, we will get back to you as soon as possible to reply. Thank you, and have a good rest of your day.
Thank you.
Thank you.